Hans, Goetti, head of investment with Asia at BIL Singapore, joins us. Hans, good morning and thank you for joining us.
Good morning.
What do you make of the current market setup? US markets are showing signs of getting, of hitting some kind of a top. Emerging markets are not doing all that well, and concerns of China clearly are occupying center stage.
That's absolutely correct. The U.S. market is in sort of a corrective mode, maybe not expressed in the indices, but underlying you see certain groups, especially IT, some of the social media stocks, not doing well at all. Just take a look at Facebook, for instance, or a few other of those. We do have sectors that are clearly lagging now, and the leadership is narrowing, which is not necessarily a good sign in the near term. The longer-term picture, however, is still, to us at least, looks relatively okay, although we don't expect the same returns as last year, but we still expect positive returns for this year, simply because the yield curve is still very steep, so it's not flattening or anything, although the Fed is tapering. But as long as you have a steep yield curve like this and economic growth on the order of about 2.5–3%, equities tend to do okay in an environment like this.
Hans, what's the sense that you're getting about the dollar? Because that is something that impacts India as well directly. Our currency, that's the Indian rupee, has been, staying at an 8-month high. But part of it is also because of the dollar weakness. What's your own sense of what direction the dollar is likely to take in a wobbly equity environment for U.S. equities?
Well, there are several cross currents when it comes to the dollar. It's pretty well locked into a trading range. If you look at the DXY, it's somewhere between 79.30 and then 81. That's more or less the trading range, and it has actually been disappointing this year because we actually expected the euro to be weaker than it is. The European Central Bank is sitting on their hands. They have not eased yet, despite deflationary pressures in Europe. But then in relation to emerging markets currencies, the US dollar has somewhat, it's relatively stable, but again, it's not exactly, it's not exactly in a bull trend. But with the Fed tapering going on, and which seems to be on target and probably ending before the end of the year, we expect the dollar not to fall below the support level of 79 on the DXY. So we expect the dollar to actually improve a little bit over the coming months, not only against the euro, but of course also against the emerging market currencies.
Hans, but in general, do you think U.S. equities are slightly overpriced now?
U.S. equities are, well, in the longer term, if you look at the Shiller PE ratio, which is a very long-term measure, you could argue they are on the high side, valuations are on the high side. We're not in bubble territory, but we are at similar levels as we were in 2007. 2000, the dot-com bubble, of course, was an aberration. PE ratios were much higher, but we are getting into territory where normally you will get corrections. So I think that there will be, going from here at least, will be a bit more choppy than it was in 2013. And as I said, we expect positive returns, but nowhere near on the order as we had last year.
Hans, what's the sense that you're getting about India? Our markets are sitting at an all-time high right now. There has been good amount of FII money as well, which has been driving the equities in the run-up to the elections, that is. Do you think this FII pumping will continue and the markets could scale, another 5 to 10% from here?
It very much looks like it. India has now a lot going for it. We have an improvement in the current account, for instance. Also the fiscal deficit or the twin deficits are no longer a concern as it was maybe 6 or 12 months ago. Then you have valuations which are attractive. Total market capitalization to GDP is only about 60% in India. PE ratios are about 13.5. We see earnings, estimates being revised upward here and there. So a lot of things are happening on the positive side. And then, of course, the political hopes, if you will, by foreign investors that you have a government which is more business friendly and ultimately will lead to a resumption in the investment cycle. I think that's the key. A resumption in the investment cycle will be absolutely decisive for India, and I think there's a lot of expectation and a lot of hope based on that.
Hans, so if I really map the kind of sectors or stocks which have done well for Indian markets this year, you got banks, cyclical stocks, industrials, machinery companies, and power-related sectors. Now, the earning momentum for none of the economy-related sector has improved. In fact, the earning momentum is rather weak for most of the economy-related sectors. So do you think somewhere the price rally in Indian equities, especially in cyclicals, is looking slightly stretched?
Well, you could argue that, but there's a justification for those stocks to do well. I think what also should do well are stocks that are tied into the global economy. And what has to be mentioned is as one of the headwinds last year was a very poor external environment. Now you have an economic recovery taking hold in the United States. Europe is doing better. So I think companies in India that are tied into the global economy, in my view, they have lagged a little bit. And I think they should do much better over the months in the months ahead.